Hello everyone, welcome to our channel Share Experience. In this video, we are going to discuss about bills of exchange. First, we'll understand the bills of exchange concept and then we will move on to the problems. In this video, we will cover only the concept along with the journal entries for various cases. First, we will understand what is bills of exchange and when the bills of exchange takes place. Let's assume that I am the business owner and I am selling goods and services to my customers on credit basis, not on cash basis, because some of my customers are not able to pay back the money to me immediately. They need some time to pay the money. Till the time my customer pays back the money, I need to have some kind of evidence or proof that I have sold my goods to him and he is liable to pay the money to me. In order to have this evidence, I use a paper or a note in which I write the credit transaction details. This note is called bills of exchange. This bills of exchange is one of the instruments of credit. Why am I saying it as one of the instruments of credit? Because like bills of exchange, there are other instruments of credit like promissory note. Now we will understand why bills of exchange is used. Whenever business owner sells the goods and services to the customer on credit basis, he has to wait till the customer pays the money to him. If the customer fails or refuses to pay back the money to the business owner, or if he delays the future payment, then this will create a problem for the business owner. In order to avoid this delay or default is nothing but the customer fails to make the payment. That is called default. So in order to avoid this default and delay, an instrument of credit is used. This instrument of credit can be bills of exchange or promissory note. In olden days, these instruments of credit is referred to hundis. There were many types of hundis in olden days. Nowadays, these instruments of credit are called bills of exchange and promissory note. We need somebody to monitor these instruments of credit. In India, these instruments are governed or monitored or controlled by the Indian Negotiable Instruments Act 1881. Now we will see how does a bills of exchange look like. We will understand the bills of exchange with an example. Andrew is the business owner, lives in Bangalore, and Ben is a customer who lives in Kolkata. Andrew sold goods to Ben on credit basis worth 60,000. They both have agreed between each other that Ben is okay to pay back to Andrew after 3 months. Now, for this example, how does a bills of exchange look like? First, we will write the amount on the left hand side, that is 60,000. Below that, we will mention the customer name and address. Here the customer is Ben. Then we have to mention the period or the date by which the customer will pay the money back to the business owner. It could be weeks, months or years. According to their agreement, the period varies. On the right hand side, we will mention the place and transaction date. Below that, we will mention the business owner name and address. And business owner will sign on it. He should sign on it. This bills of exchange is sent to the customer Ben for his acceptance. He will give his acceptance by signing on it, and he has to return it back to the business owner after signing the bills of exchange. Business owner will keep this as a proof. In this case, there are only two people involved. One is business owner Andrew and the one is customer Ben. Andrew draws the bill here, so he is the drawer. Drawer means he is the one who is writing the bill. Ben is the one who is accepting the bill. So, he is called drawee or acceptor. Here we have one more term called payee. Payee is the one who is supposed to receive the money on the due date. In our example, business owner, that is Andrew, is the payee because he is going to receive the money. In case Andrew tells Ben to make the payment to Chris, then there are 3 people involved in this transaction. maximum number of parties involved in bills of exchange should be only 3. Chris can be Andrew's supplier or creditor to whom the Andrew has to pay some payment. In this case, Andrew is the drawer who is writing the bill. Ben is a drawee who is the customer accepting the bill. And Chris is the payee who is going to receive the payment from Ben. How does a bill of exchange look like when there are 3 parties involved? We'll consider the previous example. Previously, we have mentioned me in the unconditional order, which is Andrew, because Andrew is the one who is going to receive the money. Here it is Chris, because Andrew tells Ben to make the payment to Chris. So instead of me, we will mention Chris. Based on this specimen, we will write the features of bills of exchange. Our first feature is it should be signed by the drawer of the bill. If we take the previous example, drawer is Andrew. So Andrew must sign the bill of exchange. Our second feature is it is an unconditional order to a person. Person means drawee, to pay the specific amount. Unconditional order means whatever happens, the drawee should pay the agreed amount on the due date. That is called unconditional order. Our third point is to make this document valid or valuable, drawee must accept it. Till the drawee provides his acceptance, the bill of exchange will remain as a draft version. Drawee has to provide his acceptance. Only then the bill of exchange will become valid. Our fourth feature is payment to be made must be certain. That means the payment details should be mentioned in the bills of exchange specifically. Not only the payment but also the date on which the payment is made. Here if you see in the bill of exchange we have mentioned the period of the bill, that is 3 months after the date, and also we have mentioned the date on which the bill of exchange is issued. So this point talks about the payment details. Our next feature is as per the requirement of law, the document must be stamped or else it is not valid. So the bill of exchange should be stamped. Now we will see types of bills of exchange. We have 2 types. One is trade bill and another one is accommodation bill. Trade bill is for business transaction. Whatever examples we have discussed before are for trade bills. The accommodation bill is for mutual help. Though these bills are not legally enforceable, but still they are in practice just to help each other. In this video, we are focusing only on trade bills. Now we will see what is promissory note. As we already discussed that promissory note is one of the instruments of credit. It is similar to bills of exchange, but there are slight changes. For example, Andrew lends money to Ben and Ben has agreed to pay the money back to Andrew in future. In this case, we have only 2 people involved, that is Andrew and Ben. Andrew is the payee and Ben is the drawer or maker. In bill of exchange, the bill is drawn by the business owner, but in promissory note is drawn by the customer or the person who has borrowed the money. Here Ben promises Andrew that he will pay back the money in future. So Ben becomes the drawer. In promissory note, we only have 2 parties. One is maker, other one is payee. Now we will see how does a promissory note look like for this example. Everything is similar like bills of exchange, but the customer is drawing the bill to business owner. There in bills of exchange, the business owner is the one who draws the bill. But in promissory note, here the customer is the one who draws the promissory note. That is, Ben is giving the promissory note to Andrew. Now we will see the features of promissory note. Our first feature is it must be signed by the maker. Here maker is Ben. So Ben should sign the promissory note. Our second feature is it must contain an unconditional promise to pay. In bills of exchange, it was unconditional order, but here it is unconditional promise to pay. The third feature is payment to be made must be certain. Not only the payment but also the date on which the payment is made. Same like bills of exchange, here also we should mention the payment details and the date on which the payment is made. Our fourth feature is, as per the requirement of law, the document must be stamped. Now we will see the difference between bills of exchange and promissory note. In terms of number of parties, in bills of exchange we have 3 parties, that is drawer, drawee and payee. But in promissory note we have only 2 parties, that is maker and payee. In terms of acceptance, in bills of exchange, drawee must accept the bill. Till the drawee provides his acceptance, the bill is not valid. Whereas in a promissory note, acceptance is not at all required. In terms of payee, in bills of exchange, drawer and payee can be the same party. If we consider the previous example, Andrew itself is receiving the amount from Ben. So Andrew acts as a drawer and as well as payee. Whereas in the promissory note, drawer cannot be the payee because drawer is the person who borrowed the money. So he can never be a payee. In terms of drawer, in bills of exchange, it is drawn by the creditor, supplier or seller, all are same. Whereas in the promissory note, it is drawn by the debtor, or you can say customer, or the person who borrowed the money is entitled to draw the promissory note. In terms of order or promise, in bills of exchange, it is an order to pay, whereas in promissory note, it is a promise to pay. These are the major differences between bills of exchange and promissory note. Now we'll see the journal entries in drawer and drawee books. Here I have mentioned the situation and journal entries in drawer books and drawee books. Our first situation is sold goods on credit. When drawers sell goods and services to their customers on credit basis, the journal entry will be customer debtor to sales account. If there is tax or GST, then the journal will be customer debtor to output CGST account to output SGST account to output IGST account to sales account. In drawee books, it will be purchasing, not selling. So the journal will be purchaser's account debtor to supplier or creditor. If there is tax, then the journal will be purchase account debtor, input CGST account debtor, input SGST account debtor, input IGST account debtor to supplier. Our second situation is once the bill is accepted by the customer or drawee. Once the drawee provides his acceptance to the drawer, then the journal in drawer books will be bills receivable account debtor to customer. Here, drawer has to receive the money from drawee. So, we call it as bills receivable. In drawee books, the situation will be he has given his acceptance to drawer. So, the journal entry will be supplier debtor to bills payable account. Here, drawee is liable to pay the money to drawer. So, we call it as bills payable. Our third situation is if the drawer retains the bill till the date of maturity. Now what is date of maturity? Maturity of the bill means the date on which bills of exchange or a promissory note becomes due for payment. When the bill or promissory note is arriving towards the maturity date or due date, we need to add 3 days to the due date. These 3 days are considered as days of grace. Let's understand this with an example. A has accepted a bill from B, wherein B is the owner of the business and A is the customer who purchased goods from B on credit basis. And the bill period is 2 months to date. A purchased goods on September 10th. Then the due date of the bill would be November 13th. That is September 10th to October 10th, October 10th to November 10th. And also we need to add 3 days extra as grace period. So the due date is November 13th. If the due date falls on the public holiday, then the due date will be the preceding day. Preceding day means previous day. If we consider the previous example, the due date will be November 12th instead of November 13th. If the due date falls on the emergency holiday, then the due date will be the next working day. For the same example, the due date will be November 14th instead of November 13th. The journal entry in the drawer books will be cash or bank account debtor to bills receivable account. In the drawee books, the journal entry will be bills payable account debtor to cash or bank account. Because on the due date, the drawee should make the payment of the bill. Our next situation is if the drawer decides to discount the bill at bank before the due date. Now what is discounting the bill? If the drawer needs money before the due date of the bill, he can approach the bank for encashment of the bill. Encashment means taking bill amount. Bank will make the payment of the bill to the drawer after deducting some interest. This process of encashing the bill with the bank is called discounting of the bill. Finally, bank gets the amount from the drawee on the due date. Now, how will the bank calculate discounting charges? Discounting charges are calculated based on two factors. The first one is the rate of interest and second one is the period of maturity. For example, if the bill value is 10,000 and it is payable after 3 months, the bill period is 3 months. Discount percentage is 12% per annum. Then the discounting charges will be 10,000 into 12 by 100 into 3 by 12, which comes to 300. This 300 is discounting charges. Now we'll see the journal entry in drawer books. The journal will be cash or bank account debtor, discounting charges account debtor, input CGST account debtor, input SGST account debtor to bills receivable account if there is tax. Otherwise, the journal will be just cash or bank account debtor, discounting charges account debtor to bills receivable account. In drawee books, there will not be any entry because drawer is discounting the bill with bank. But the drawee will pay the bill amount only at the time of the maturity, on the due date. Our next situation is if the drawer decided to give the bill to his creditor. Now what is giving the bill to creditor? When the drawer or holder of the bill, or you can say the seller or supplier, all are same, decides to transfer the bill to a third party, then we say the bills have been endorsed. Let's understand this with an example. The seller or the holder of the bill has decided to transfer the bill to his creditor, wherein he has to pay some amount to his creditor. For that creditor, the seller has decided to transfer the bill. It is called as endorsement. In this case, seller is called endorser, and to whomsoever it is endorsed, that person is called endorsee. In this case, creditor is the endorsee. One point we should note here, that is, once the endorsee receives the bill from drawer, he can deal with the bill of exchange in the same manner as the drawer. That means he can also transfer the bill to the third party. Now we will see the journal entry in drawer books. The journal will be creditor debtor to bills receivable account. In drawee books, there will not be any entry because drawee will pay the amount on due date or at the time of maturity of the bill. Since we have transferred the bill to the new party, in the endorsee's books, the journal entry will be bills receivable account debtor to endorser. At the time of maturity, in endorsee's books, the journal entry will be cash or bank account debtor to bills receivable account. Our next situation is drawer decided to send the bill to bank for collection. Now, what is sending the bill to bank for collection? Usually, drawer can retain the bill till maturity and receive the amount from the drawee as per the bill. But if he thinks about safety, he can send the bill to bank for collection. Assume that the drawer sends the bill to bank for collection. The bank will retain the bill safely and present it for the payment on the due date, that is at the maturity of the bill. The journal entry in the drawer books will be bills sent for collection account debtor to bills receivable account. In drawee books, there will not be any entry because drawee will pay the amount on due date or at the time of maturity of the bill. If we notice here we are debiting to bills sent for collection account. Once the amount is realized by the bank at the time of the maturity, then the entry will be bank account debtor to bills sent for collection account. When we send to bank for collection, then we are debiting bills sent for collection. When the bank credits the drawer's account at the time of maturity or on the due date, we are crediting bills sent for collection account. Before going into the next situation, we need to understand three terms, that is dishonour of a bill, notary public and noting charges. First, we will see what is dishonour of a bill. Usually, the bills of exchange is presented for payment on the due date or on the maturity date. If the drawer refuses to pay the bill amount on due date, or if he doesn't have sufficient funds to pay the bill amount to drawer, then it is considered as dishonour of a bill. Let's understand all the 3 points, that is dishonour of a bill, notary public and notary charges with the example. Assume that the drawer sent the bill to bank for collection along with an instruction or a note stating present the bill on due date for payment. If the drawee refuses to pay the bill amount, or if the drawee says I don't have sufficient funds to pay the bill amount, then get it noted or protested by notary public. This is what the instruction that the drawer has given to bank while sending the bill for collection. Now assume that the drawee refused to pay the bill amount. At this point, the notary public comes into picture. Now what is notary public? Notary public is an officer appointed by the central or state government to control or exercise the powers and functions relating to noting and protesting of negotiable instruments for dishonour. Noting indicates the fact of dishonour, which means drawee has refused to make the payment and it is noted by notary public. For providing this kind of service, a fees is charged by notary public. This fees is called noting charges. For these situations, we need to record the entries for noting charges and dishonour of the bill in drawer and drawee books. When the drawer retains the bill till due date and the bill is dishonoured on the due date, the journal entry in the drawer books will be drawee debtor to bills receivable account to cash or bank account. Here I have mentioned cash or bank account because if there are any noting charges applicable, only then we should mention cash or bank account. Otherwise, the journal will be drawee debtor to bills receivable account. Our next situation is when the bill is discounted at bank and it is dishonoured. The journal will be drawee debtor to cash or bank account. This means the drawer has already got the payment from bank When the bank approached the drawee on the due date, the drawee has refused to make the payment. So it is dishonored. Our next situation is when the bill is endorsed and it is dishonored. Then the journal will be drawee debtor to endorsee in the drawer books. Our next situation is when the bill was sent to bank for collection and it is dishonored. The journal will be drawee debtor to bill sent for collection account to cash or bank account. In drawee books, there will be one journal for all the situations, that is bills payable account debtor, noting charges account debtor to creditor account, because the drawee has to pay the bill amount, along with that he has to pay the noting charges if applicable. That is why we are debiting noting charges along with bills payable. Our next situation is if the drawee requests the drawer to cancel the bill. Now what is cancelling the bill? Now we need to understand one concept, that is renewal of bill. If the drawer doesn't pay the bill amount on the due date, or if the drawee doesn't have enough money to pay the bill amount on due date, he can request the drawer to cancel the old bill and create a new bill. In this case, if the drawer agrees to cancel the old bill and create a new bill, then this process is called renewal of bill. Here we should note one point. Since the drawee himself is approaching the drawer to renew the bill doesn't have to be noted by notary public. This means the drawer will not approach notary public. If the drawer charges interest for cancelling the old bill and creating the new bill, the drawee can pay the interest amount by cash, or the interest amount can be included in the new bill. The interest will be calculated based on three things. First one is amount of the bill. Second is the rate of interest. Third is period of new bill. In this case, we need to record entries in drawer and drawee books for cancelling the original bill, recording interest for the extended period, for part payment received, and finally for creating the new bill. For cancelling the original bill, in drawer books, the journal will be drawee debtor to bills receivable account. In drawee books, the journal will be bills payable account debtor to drawer. Our next situation is recording the interest for the extended period. The journal in drawer books is drawee debtor to interest account. Here we are crediting the interest because the drawer is receiving the extra income apart from the bill amount. So interest is an income. So we are crediting interest account. In drawee books, the journal will be interest account debtor to drawer. Here interest is an expense because along with the bill amount, he has to pay extra money for interest. So we are debiting interest and crediting to drawer. Our next situation is part payment received from drawee. If at all the drawer has received some part payment while cancelling or before cancelling the bill, then the journal in drawer books will be cash or bank account debtor to drawee. In drawee books, the journal will be drawer debtor to cash or bank account. Once the new bill is issued, in the drawer books, the journal will be bills receivable account debtor to drawee. In drawee books, the journal will be drawer debtor to bills payable account. Our last situation is retiring the bill. Now what is retiring a bill? Retiring a bill under rebate. Rebate is nothing but like a discount. If the drawee is okay to pay the amount of the bill before the due date, it is called retiring the bill. Assume that the drawee has sufficient funds, so he is okay to pay the bill amount to the drawer before the due date. That means before the maturity of the bill. Usually in this case, the drawer allows a discount or a rebate to the drawee for paying the money before the due date. In this case, the journal entry in the drawer books will be cash or bank account debtor, rebate account debtor to bills receivable account. If we notice, we are debiting rebate account. Whenever we are allowing the discount or rebate, we treat it as an expense. So we are debiting the rebate account. In drawee books, drawee is receiving the rebate or receiving the discount. Discount received is an income. So in the drawee books, we are crediting discount, that is crediting to rebate account. The journal in the drawee books will be bills payable account debtor to cash or bank account to rebate account. We will understand about these journal entries in detail while solving the problems. In the next video, we will solve different problems. Hope you guys have understood the explanation. If you guys think that this video is helpful to you guys, do not forget to click on the subscribe button. Thanks a lot for watching this video.